A great company can still be a terrible investment if you pay too much for it. These three stocks were amongst the S&P's best performing companies just 2 years ago, but over the last 12 months, they've all dropped hard. And the thing is, the warning signs were there for everyone to see. So let's break this down. How do you actually know when a stock is overvalued? I'm going to start with a metric that most investors use, but very rarely use well. The PE ratio. Back in 2024, Supermicro Computer had an amazing story. AI servers, massive growth, demand everywhere. The stock shot up almost 300% in just 2 months. But whilst the share price was rocketing, the PE ratio was also going up. The PE is the share price divided by the earnings per share. Basically, it's how much you're paying for every dollar of profit the business makes. Typically, if the PE is below 20, that's a low valuation. Between 20 and 30 is medium to high, and above 30 is high. You're going to have to be expecting some serious growth to back that up, but it's perfectly possible. Microsoft, Amazon, Nvidia, they all commonly trade at the late 20s to 30 PE range because those businesses are growing a lot every year. So let's go back to Supermicro's chart. As the price shot up, the PE ratio rose with it. And once we overlay our valuation bands, low below 20, medium up to 30, and high above that, it's pretty obvious this wasn't just a hot stock. It was becoming dangerously overvalued very fast. And it didn't take long for the share price to crash back down into the normal range. So it seems pretty simple, right? Just avoid stocks with a PE above the 35 to 40 range and you're safe. Yeah, not quite. And this is where most people misuse the PE ratio because it is good at valuing stocks based on their past earnings, but for valuing growth, it's crap. Take a look at the average PE ratios across different sectors in the S&P 500 today. They're pretty wildly different. Tech is at 52, whilst consumer defensive is just 24. Now you'll hear and read a lot that tech stocks are just overhyped or trendy, and that's why their PE ratios are so high. But that's just not true. That's surface level thinking. Let me show you why by going back to this data and adding in the average 5-year sales growth for each of these sectors. And this is the 5-year actual sales growth, real data, not estimates. The 3 sectors with the highest PE ratios also have the highest sales growth. Companies like Meta, Netflix, and Alphabet are really dragging up the growth figures for the communication services sector here. In many cases, higher valuations actually make sense, because the businesses behind them are growing way faster than the average. And when a business is doubling its sales every few years, then a high PE isn't a red flag. It's just a reflection of real growth. That's what a lot of people don't get about the PE. It's why Microsoft can sit at 30 PE and no one freaks out, because the business is still growing fast enough to justify it. So if we want to value companies that are growing quickly, we need another metric, one that takes earnings and growth into account. The price earnings to growth ratio, or PEG. Here's how it works. The PEG is the PE ratio that we just looked at divided by the company's expected annual earnings growth rate, generally over the next 5 years. Some PEG calculations use different earnings growth rates, so make sure you check. Finviz.com shows the 5-year expected earnings PEG, so that's a good place to get it, as well as all the other metrics I'm going to mention in this video. A PEG less than 1 indicates the stock is undervalued. All it should have to do is meet its expected earnings growth figures, and the share price should experience a strong positive correction. Between 1 and 2 is pretty typical and generally fairly valued. Between 2 and 3 is getting quite high, and anything above 3 indicates overvaluation. At this point, the stock will need to significantly exceed its expected earnings to justify its valuation. And this isn't just theory or opinion. Like everything on this channel, it's backed by real data. This study by Dean Hodgkiss split thousands of stocks into 5 groups, from those with the lowest price earnings to growth ratio to those with the highest, and then plotted them over a 10-year time period. The results are clear. This group of stocks with the highest PEG ratios, i.e. the overvalued stocks, vastly underperformed, whilst the 2 groups with the lowest PEGs, i.e. the undervalued stocks, were the strongest performing, achieving around 30% compounded annual returns. So to spot an overvalued stock, we want to look at both the PE and the PEG and compare the balance between the two. A slightly high PEG of around 2 is generally okay if the PE ratio is reasonably low. A good example of that right now is Meta, which currently sits at a PE of 24 and a PEG of around 2.4. Definitely not cheap, but not mega overvalued either. Likewise, a high PE ratio of say 35 could also be okay if the PEG is really low. A large profile example of that kind of setup is Nvidia, who tend to hover around those kind of figures. Right now its PE is 40 and its PEG is 1.4. Again, a touch high for sure, but certainly not scarily overvalued. But things start to look very sketchy when you see both a high PE and a high PEG, like Tesla, with a PE of 183 and a PEG of 8.5, meaning not only is it overvalued based on its earnings right now, but it'll still be overvalued even if it hits its expected earnings growth targets. But these two metrics present us with a problem, because not all businesses are profitable, and you can't calculate the price to earnings or the price earnings to growth if there are no earnings. And this is super relevant because a lot of stocks that do become overvalued are loss-making, young and exciting businesses. They crop up a lot, and so we still need to be able to value them using something other than earnings. What we can use instead is the price to sales ratio. In fact, the price to sales is criminally underused. In his famous book, What Works Well on Wall Street, Jim O'Shaughnessy describes the price to sales as the king of the value factors, saying it indicates valuation even better than earnings related metrics. And he did research to back that up, which clearly showed that stocks with low price to sales drastically outperformed, whilst those with higher price to sales underperformed. So it's a great metric for us to use. Let's take an example of a loss-making company that I showed quickly at the start of the video, Moderna. They were losing money in 2023 and 24, but they still experienced a 137% share price rise in just a 7-month period. And you couldn't evaluate their PE or their PEG over that time. So instead, let's overlay some reasonable bandings for what's considered a low, medium and high price to sales. The average price to sales for the healthcare sector is around 4. Moderna's peaked at just over 12. Suddenly, we can clearly see that spike was deep into overvaluation territory for that sector. So now let's take those three metrics and apply them to the best performing stock over the last 12 months. A stock that saw a share price rise of 450%, beating every other company on the S&P 500, Palantir. Here's its annual revenue and earnings for the last 4 years. They make for pretty good reading. And here's its market cap, which is the total value of the company. So before we look at the valuation figures, let's first play a game using that information. Do you think Palantir is A, undervalued, B, fairly valued, C, slightly overvalued, or D, mega overvalued? Have you picked? Okay, so Palantir's price to earnings is 556. Yeah, that's not a mistake. It's trading at 556 times its earnings. I'll just readjust my graphic. Okay, that PE is high, but Palantir is a high growth business, so the PE isn't everything. The price earnings to growth ratio could save it, but that's at 16.8. Yeah, I had to change that graphic too. Both pretty high so far, but Palantir has only been profitable for 2 years. Its profit margin is decent at 18%, but it's not massive. So the price to sales ratio could be more reasonable, except it isn't. It's massive. It's 97, which makes Palantir look pretty overvalued. Okay, that's all well and good, but this final bit, this is the juicy bit of the video right here. Because this is what no one else tells you to analyse. Palantir is clearly overvalued right now, but that doesn't mean the share price will drop. Because the key metric for valuing this type of high growth company is the price earnings to growth ratio. And that metric uses the expected earnings growth. That's the growth market analysts on average expect Palantir to grow its earnings by over the next 5 years. But they could be wrong. In fact, they almost certainly are. Depending on the time period you look at, around 50% of stocks go on to beat their expected earnings, although about 40% miss them as well. But Palantir have been beating each of their earnings targets for a while now. So there's a good chance their expected earnings are actually lower than what they're really going to achieve. So what we need to look at is what happens if they beat their earnings. This is not hard to do, but it's where you'll get really good at spotting overvalued stocks. It'll take you the level above the average home investor. Let's reconstruct the PEG ratio and take Palantir's current price and current earnings like before, but now we want to change this figure, the expected annual earnings for the next 5 years. What would that have to be to move the PEG down from its current 16.8 to something more reasonable like 2? Well, it would have to be 278% per year, which is just over 8 times more than the current expected earnings growth of 33%. Is that impossible? Well, nothing's impossible. Who could have expected Apple's earnings growth the year before they launched the iPhone? But what I would say is it's going to take something extraordinary for Palantir to meet its current valuation. And I think that's more like gambling than investing.